Hello everyone. So in this lecture, I am going to take ahead with the discussion of the derivative. So let us understand that what is the need of this derivative, that why we have invented this derivative product. Means if I am saying now there is equity, I am buying equity because I am looking to invest my money in some assets. But what is derivative? What is the need of the derivative? Means okay, it's derive its value from the underlying, that what is the need of the derivative, that we need to understand. Then before entering into that, let us understand the three different types of participants in the derivative market. One is the hedger, the one who needs to hedge his position. Then we have the speculator and the arbitragers. So arbitragers is the one who is available in every market, because their whole aim is to find out the mispricing and take the benefit out of it. Clear? Now speculators are the one whose just aim is to make profit from the movement of the price of the derivatives, and the hedgers are the real users of the derivative, real users of the derivative contract. Now let us understand some of the situations where hedgers are actually utilizing the derivative contract to protect themselves. First example, if I'll take that I am an oil producer. I produce oil and then I sell the oil in the market. Now if I have to sell the oil today, then I can sell it at today's price, say 40 per liter, 40 per, say rupees 40 per liter. I can sell it today. I am not worried about it. But what's my worry? My worry is that I have to sell the oil because I am going to produce it after 1 month. So I have to sell it after 1 month. So now I am worried about something. I am worried about the price of the oil to fall. Now the biggest catch over here is that the price is not constant. It keeps on moving up and down. And if I am an oil producer, I am going to produce the oil. I have to sell it in the market. Then what's my concern? If the price will rise? No. Because if the price will rise, I will make huge profit. But what's my concern? What's my fear? The price will fall down. And if the price will fall down, I have to bear a loss. Try to understand, if the price will fall down to say rupee 30 per liter, and we know that prices are fluctuating, they can go anywhere. So if I am an oil producer, my concern is, sir, I am going to lose 10 rupees per liter. So now when this oil producer is little worried, then you reached him and you told him that, Mr. Oil Producer, you don't have to worry about, you can hedge yourself. With the help of derivative contract. You can protect yourself with the help of these derivative contracts. Now the oil producer, how come? He said that if you are afraid of the fall in the price, of the oil, then you can sell futures. Or you can buy put option. You have both the options. Either you can sell the futures in the market or you can buy put option. Now these two are meant you to protect from downside risk. Now I am not entering into the option now. Let us continue myself in the futures and forwards. So what is the meaning of futures and forwards? It says, suppose Mr. A is the oil producer, Mr. B is the different person. So Mr. A is oil producer. Currently he is selling oil at rupees 40 per liter, but he is afraid that after 1 month the price of the oil will reduce. So he will do a contract with Mr. B. Mr. B. Mr. B is the buyer of the oil. Now try to understand from both the perspective, from both the person's perspective. Mr. A is afraid of fall in price. Mr. B is afraid of rise in price. Try to understand. Don't note it down without understanding. You are the buyer of the oil. You are an aviation company. Try to understand. Mr. A is oil producer and you are a aviation company. And aviation company needs oil. And if the oil price will rise, your input cost will rise, your profitability will fall. So after 1 month, your concern is rise in price. After 1 month, my concern is fall in price. We both enter into a contract and we contracted that we will deal that I will sell you oil at the rate of 42 per liter. I will sell you oil 42 rupees per liter. Now Mr. B is fine that after 1 month, whatever the price will be in the market, he is able to buy oil from Mr. A at the rate of 42 rupees per liter. So this is a contract price. Now you decided that Mr. A will sell at 42, Mr. B will buy at 42. Suppose the price will reach to 48 rupees per liter. Who is at loss? Mr. A is at loss. Mr. A is at loss by rupees 4 per liter. Clear? And Mr. B will gain rupees 6 per liter. Clear? So one person will earn, another person will lose. One person will earn. Over here, who is earning? Mr. B is earning. Who is losing? Mr. A is losing. Suppose after 1 month, the price reach say rupees 32 per liter. In this scenario, who is the winner? Mr. A. Because the price of the oil in the market is 32. Still, he is able to sell it at 42. Try to understand. Sir, today price is 40. I contracted with you at 42. But after 1 month, oil is selling at 32. So Mr. A, I am the producer and I feels like that, oh God, it's good that I have done this contract. The price is 32. I am able to sell it at 42. I am the God. I am making huge profit. So Mr. A will be at profit of rupees 10 per liter. But think it's from the Mr. B's perspective. He was afraid of the rise in price. So he went long in the futures. He bought the futures contract that he will buy oil at the rate of 42 from you. But now the price is only 32. So try to think, Indigo is buying oil at 32, but SpiceJet, who is in contract with Mr. A, is buying oil at 42. So the profitability of Mr. B will hurt. Now try to understand that one side you are protected, but other side you are not protected. Means if you had a contract of 42, and Mr. A is the buyer of the futures, Mr. A is the seller of the future and Mr. B is the buyer of the future. So if the price will rise, Mr. B will gain. If the price will fall, Mr. B will lose. If the price will rise, Mr. A will lose. If the price will fall, Mr. A will gain. So one person's loss will be the other person's gain. One person's gain will become the other person's loss. This is how we enter into a contract. But at least they both will be able to safeguard themselves. Let us understand. The price is 42, but it increased to 50. Now, Mr. B is a SpiceJet. Okay, one of the airlines. Now, SpiceJet is buying oil at rupees 42 per liter, but other companies say like Indigo, they are buying oil still at 50 per liter. So in this scenario, SpiceJet will be able to deliver good profitability. But if the prices of the oil will reduce to 30, then SpiceJet is still buying at 42, but Indigo is able to buy it at 30. So in this scenario, it is going to hurt. But you have to protect your fear. You have to enter into the derivative contract. So one side there is a fear, the other side there is a loss. Clear? So accordingly, the companies need to choose that what they have to do. Now, the process which they have done is known as hedging. That they have hedged their position. They hedged their position. What was the position of Mr. A? He have a huge amount of oil. He want to protect himself. So he is selling the future contract. So always remember, if you are afraid of the decrease in oil price, you have to sell the future. You have to sell future when you are afraid of something which is going to fall. Clear? And when Mr. B, he is afraid of rise in price. So always when something is going to rise, you have to go with F plus or long futures contract. Long future contract. Clear? Now let us understand the same in the different scenario. Mr. A and Mr. B. Now they had a contract of 42. They had a contract of 42 where Mr. A is the seller of future contract and Mr. B is the buyer of future contract. Now what is that meaning of future contract? This means that in future I contract with you that I will buy oil at the rate of 42 from you. Again I am repeating the same statement, you can note it down as well. I am doing a contract for future, say after 1 month, that I am going to buy. See, the word buying future means I am going to buy the underlying. Derivative is always based on the underlying. So I am doing a contract with you. I am doing a contract with you that I will buy oil at the rate of 42 from you after 1 month. Future contract. See the word future, in future. Because if today there is no uncertainty, today is it trading at 40, I can buy. What's the uncertainty? Futures. The price can be anything. I am afraid of the price will rise. I am an aviation company. I have to protect myself. What I have to do? I have to buy the futures to fix my price, to lock my price. So means when it comes to buying the futures means you are buying the underlying. You are buying the underlying contract, or you can say you will buy oil. And when you are selling the future, you are making a contract to sell oil at the rate of 42 after 1 month. So time must be specified. Whenever you are dealing with a contract, time must be specified that when you will deliver the oil, at what rate. The rate is given in the contract. This is a contract. In the contract, you will get to know that Mr. A will deliver which commodity? Oil, gold, silver, agriculture commodity, or any stock, any currency, any interest rates, bonds, anything. So what you will deliver? What you will deliver? Apart from that, when you will deliver? When you will deliver? This will give you the time of the future contract. This will give you the time of the future contract. Next, at what rate? At what rate you will deliver? At what rate you will deliver? So means you are specifying all these three terms in your contract book. Clear? And they both parties, A and B, they both bind to this contract. They both bind to this contract. Clear? Now, this is the spot price. Means the price of the oil today, spot, on the spot. What's the price of the oil today? Futures price 42. Means after 1 month, you will buy at 42. So can you see the price increase to 42? Can you see the price increase to 42? Now, what is the reason of this increase? What's the reason of this increase? That will come under the pricing of the futures. Pricing of the futures. So means you have to do the understanding. You have to full understanding of the futures, that how you will price a future contract. That is 42. Then this is the point of time when you started, and this is 1 month. Over here the spot price is 40. Over here the future price is 42. But suppose after 15 days, you plan to cancel the contract. And you both are mutually exclusive to that both parties are ready that okay, let's wind up the contract, no issues. So on this date, suppose the future price is trading at 38. Suppose the future price is trading at 38. So in this scenario, Mr. A will make how much? Rupees 4 per liter. Clear? And Mr. B will lose rupees 4 per liter. So this part is known as valuation. This part is known as valuation. This part is known as pricing. This part is known as valuation. You need to do the value. You need to find out the value for each party. Valuation means finding out the value for Mr. A and Mr. B. Now tell me, what is the value over here for Mr. A and Mr. B? Over here the value is equals to 0. Because with futures and forwards, at the initiation of the contract, means now at 4:15 p.m. the value of the future contract is 0. By 4:16 p.m. it can be anything. But the point of time, the value of the futures or forwards is going to be 0. Say over here is 4:15 p.m. Over here you started a contract whose future price is 42. But say you will reach over here 14, 15, 30 seconds. After 30 seconds, the price of the spot is moving. Spot price is moving. And from the spot price, derivative is deriving its value. Suppose the spot increase. So future will increase to say 14.30. Now over here, Mr. B will make the profit of 30 and Mr. A will, 0.30 and Mr. A will lose 0.30. This is the valuation. But over here, at the initiation, the value to A and B is equals to 0. So means at the beginning, the moment you initiated a contract, neither you are earning nor Mr. B is earning. Neither you are earning nor Mr. B is earning, because if at the initiation I am earning something, I will close it immediately. And there is a possibility of arbitrage as well. Because try to understand, you have an asset, you buy it at 40, and immediately, means without even a second, you sell it at 41. So means this is an arbitrage profit. Clear? So at the initiation of the contract, there is no profit, no loss to both the parties. But yes, after some seconds, it can be anything. Getting my point? So the pricing of the asset and the valuation of the asset. Clear? Similarly, this was a commodity. Oil was a commodity. Try to understand from a different perspective. Say, let us enter into a bonds. Clear? Mr. A, he wants to buy a bond. But after 2 months. He don't have the money now, but he wished to invest in bonds, but after 2 months. Clear? Mr. B, he want to sell his bonds. After 2 months. Try to understand. From oil, this one is going to be little complex, but things will become simpler when you will put your mind. The concepts are same. Mr. A is afraid of what? He wants to buy bonds. Okay. When I want to buy something, what I'm afraid of? The price to rise. So I'm afraid of rise in price. When I have to sell something after 2 months, what I'm afraid of? The fall in price, because I have to sell that asset at a lower price. I have to buy that asset at a higher price. They both enter into a contract that Mr. A will sell the bonds at say 102 rupees per dollar. Mr. A will buy and Mr. B will sell the bond at 102 per dollar, and they both agreed. In future, the price can be anything. Say the price of the bond reached to 106 per dollar. Now the price of the bond is also moving up and down because of the change in the interest rate in the market. Clear? So over here over here, try to understand. When I have to buy, means what? I bought the futures. When I have to sell the asset, that means what? I sold the asset. Clear? This much is clear to you. So from here onwards, if the contract was at 102, I am selling it at 106. That means what? The buyer of the future, he made a profit of $4 and the seller of the future contract made a loss of $4. Clear? This price needs to be compared with the original future price. Clear? Apart from that, there are different assets on which we are going to study about the forwards, like equity. We can do it on commodity. We can do it on bonds. We can do it on interest rates. Clear? We can do it on currencies. Clear? How come we can do it on interest rates? Mr. A have the belief that interest rates are going to rise. Interest rates are going to rise. Mr. B have the belief that interest rates are going to fall. So there is a product whose name is FRA, a derivative product. The name of the product which can trade you in interest rate is known as FRA. So Mr. A is going to buy FRA. Mr. B is going to sell FRA. Clear? Getting my point? This can be done hedging as well. How come? Mr. A wants to borrow the money. And when you want to borrow money after 1 month, what you are afraid of? I am afraid of rise in price. So to protect myself from the rise in price, I will buy the FRA. Mr. B, he want to invest money after 2 months. He is afraid of what? The fall in price. Today the interest rate is 7%, but after 1 month, after 2 months, what if the interest rate decrease to 5%? I have to invest my big chunk of money at the rate of interest of 5%. But today I can lock my interest rate. Say 6.80. Clear? So I can invest my money at the rate of 6.80. Clear? So what I am doing? I am the seller of FRA. Clear? I am the seller of FRA. So this is how the derivative contracts work. This is the part of the hedger. Then the next part is of the speculator. I am the speculator. I do not hold any asset. Just like oil producer holds the oil, bond buyer in the future wants to buy the bond seller in the future hold the bonds. I want to borrow the money, you want to invest the money. So there was some grounding behind. But what if I do not hold any bonds, I do not hold any equity, I do not hold any currencies or commodities? My pure agenda is to make the profit from the rise and the fall in the price of the assets. The rise and the fall in the price of the asset. Now simply you can say, sir, directly then why don't you buy S plus? Why don't you directly buy the commodity? Why don't you directly buy the currency? Why directly don't you buy the equity? Why you are entering in the futures or derivative segment? See, one of the most important reason is the leverage. Leverage means, try to understand, if I'll buy the shares today, say I have to buy shares of Reliance, okay, and the price of the Reliance is $1,000. So if I have to buy 100 shares, I have to give $1 lakh. I have to give $1 lakh. Clear? But if I'll buy futures, I don't have to give a single penny. I don't have to give single penny to have the contract of 100 shares. Clear? Apart from just margin, that is going to be 5 to 10% of the whole contract amount. So means without using my own money, I still have the exposure of 100 shares of Reliance. So this is going to be helpful. This is going to be beneficial for you. Clear? That's what the role of the speculator is. They want to take the benefit of the leverage. Leverage means small amount of equity, huge amount of debt, and the exposure is same as that of the buying the 100 shares of stock. So if the exposure is same, the profit is same, the loss is same, and investment is less, don't you think it attracts me? Yes, I am going to attract it towards that derivative product where my investment is lesser. Clear? Now coming to the arbitrager. The arbitrager, they feel that if they are getting the same assets in two markets, say A and B, and over here the asset is trading at 40 per dollar and over here the asset is trading at 45 per dollar. So what they will do? They will buy from here, sell it over here. They will buy something which is undervalued and they will sell where it is overpriced, and they will make a risk less profit. They will make risk less profit. Clear? But eventually these arbitrager are going to help the market. How come? Because they are buying in the market A, leads to the rise in price, say 42.50, and over here they are selling a lot, so the price will come down to 42.50. So means they are bringing the equilibrium in the market, they are bringing the right pricing of the product in the market, and that is done in today's world via models, via computer systems, via algorithms. So it will take few seconds to make the equilibrium in the market. If there is any mispricing, the computer system will exploit the same in few seconds. Clear? So means arbitragers earn riskless profit, and the arbitrage comes because there is mispricing. So whenever you price an asset, write down, whenever you price an asset like 40 was the spot, 42 was the future price. So if this is your pricing, then you need to ensure that this is your arbitrage pricing, or you can say the law of one price. Why? Because they both have the same payoff in the future. So the price of both should be the same today. The price of the both will be the same today. Now difference between them is the interest rate. That why futures is costly as compared to the spot is the interest rate. See, in the spot you are putting your $1,000 or say $1 lakh, but over here you are putting only say $10,000. So means what? This is attractive, and if this is attractive, then over here you need to pay extra. Try to understand, something which is attractive is going to be costly. So if future is attractive, why it is attractive? Because you are not investing anything, so it is going to be costly. Spots, they will take you big chunk of money from your pocket, so it's priced lower. But at the end, after 1 month, they both started like this, 40 and 42, but at the end suppose it's 50 after 1 month. So the spot price will also be 50 and future price will also be 50. So if both the product will have the same payoff, then pricing should be done accordingly, that there will be no arbitrage. We call this as law of one price. Write down, law of one price. Clear? That if there are two assets which are identical, they have the same payoff, then the pricing of those assets must be same. Clear? That we need to take care. Now there are two contracts, one is the futures, another one is the forward. The only difference between the future and forward is that future is exchange traded, forward is over the counter derivative. This one is exchange traded and this one is over the counter derivative. Like if I have to deal with a friend, it will become over the counter, and if I am going to the exchange buying the future contract, it will become exchange traded. Now, is there any difference between forwards and futures? The difference comes from the interest rate. See what happened now. In the exchange traded market, there is mark to market. Mark to market means today when I initiated the contract is 42, and at the end of the day the future contract is 45. So F plus will receive $3 today from F minus. So means they are settling they are doing the settlement every day. They are doing the settlement every day. So try to understand over here F plus received $3. He will invest that $3 and he will earn interest. He will earn interest, and at that point suppose interest rate is high, and at that point suppose the interest rate is high. I am the buyer of the future. I am investing that $3 at a very high interest rate. I am making more money. I am making more money. So the futures are considered to be better than forwards when there is a correlation between future price and interest rate. When there is a positive correlation between the futures price and the interest rate. Try to think oppositely. The price from 42 reduced to 37. 42 to 37. I am the buyer of the future. I have to pay $5. I have to pay $5. But as I am saying, when the future price is falling, interest rates are falling, I can borrow that $5 at a very smaller amount, at a very smaller interest rate. So means what? To the buyer of the future, it is going to be beneficial when the interest rate will fall and when the interest rate will rise. Why? Because the future price is correlated to that. So this is the reason that the future value, the price of the future contract is greater than the price of the forward contract. Whatever will give you extra benefit, whatever will give you extra return, whatever will be going to give you extra amount of money, that will be traded at a higher price as compared to other product. Clear? So you can write it down. You can write it down that when future price and interest rates are positively correlated, then the price of the asset, then the price of the futures, then the price of the future is greater than the price of the forward, Clear? So in this lecture I have given you a brief introduction about the futures and forwards. Also this very important point is also covered up, the difference between the forward and future. This point is very important. Okay, you should mark it down as an important area. Apart from that, we have understood the concept of hedging, arbitraging and speculation. Clear? So in the next lecture we'll take this ahead. Okay, thank you. I am ending this lecture here.